The basis of any successful and sustainable business is successful and sustainable, healthy financials. In order to achieve that goal, you need a proper accounting system to manage your financials in. The Orax Service Delivery provides such a system for you, and this is a quick overview of the financial tools in Orax SDI. So all the accounting is done under the Ledgers menu, and there are several tabs on top to access all the different parts. The financials revolve around the general ledger. The general ledger is a list of accounts, each with a debit and a credit column. When all those accounts are added up, they should balance, so the debit and the credit totals should be the same. Those are your basic checks and balances for accounting. The general ledger is where all transactions are captured, and several reports are available on the general ledger. The first is the profit and loss statement. This is where you measure the performance of your business. That means how much profit are you actually making, and that is usually done on a month or a quarterly or an annual basis. And you use this profit and loss statement to tweak your financials. That means, are we spending too much? Are we making enough? Is there something we need to adjust during the financial year in order to optimize the outcome? That means make more profit and less of a loss. So it's important to keep in mind that the financials are done on a year-by-year basis, which is set up in the corner here. If you click on the date, we are currently in the 2021 date, you have the option to select different financial periods. So every year is managed separate from the other. Each one starts with opening balances and ends with closing balances. And once you've completed a financial year, the auditors or accountants would take the trial balance, which is basically a complete summary of your general ledger. That means the total of every account added together, which has to balance. Each account has a debit or a credit closing balance. And this information is then used to create financial statements for your company, which would be those that are submitted to the tax authorities and used for your financial performance for the directors or owners of the company. Okay, so first and foremost, the profit and loss statement. Then you do have a budget option. So in order to proactively manage curveballs and changes in the economy and the market, you will most probably want to set up a budget in the beginning of the year, which you can revise, but you use that budget to compare it to your profit and loss statement, which is your actuals, so that you proactively can adjust if things start to change. That means if there's a change in the market and your profit is dropping, in order to prevent a problem at year end, you can see that change, that variance in your budget during the year, and then proactively adjust other areas of your business in order to ensure that you are safe and prudent in your finances. So the trial balance used by accountants. Now it's important to know that the accountant has the ability to log into this system. There's a specific security privilege, and the accountant will see something like this. They are only able to see, to basically draw reports. They cannot change data, but they have access to the trial balance that they can download, and then they can go query any of the general ledger accounts or reports in order to ensure that they know exactly what is going on in your financials, and they can advise you and support you in that sense. So anybody who has access to the ledgers module, the accounting module in the system, needs the accounting privilege. And keep in mind that that should be a very small group of individuals. It may be that only 2 or 3 people have access to this, because this exposes your financial records. Anybody who captures bank statements may need access to accounting, but you are able to create a custom menu so that an individual can capture a bank statement without having access to the complete financials. So going back to the reports, the other important report is the balance sheet. So whereas the profit and loss sheet statement shows you your performance, the balance sheet technically shows you your health at a certain point in time. So as you carry on making profit and loss over since the beginning of your business, the start of the business, you would be accumulating liabilities and assets, and they are shown in the balance sheet. So that means after trading for several years or months, you would end up with specific assets and liabilities like loans and vehicles and inventory and debt and cash on hand, and those are seen in the balance sheet. So the trial balance is a combination of the profit and loss statement and the balance sheet. So that's why an accountant only needs the trial balance, because from the trial balance they can build a profit and loss statement, they can build a balance sheet, and they can also build a cash flow statement. So everything in accounting revolves around the general ledger, which is a list of accounts, and you can query those accounts individually, which will be a list of transactions and possible budgets related to that specific account. In order to populate the general ledger, you have to post transactions to the general ledger. So in the system there are several journals and ledgers that where transactions originate, and they have to be posted to the general ledger, and that has to be done manually by clicking the post transactions to general ledger. So typical source journals would be sales invoices. That is probably the most common. Every time you sell, every invoice, every line on an invoice would end up as a transaction in your general ledger in some of those general ledger accounts. Purchase invoices, those are sales invoices. Purchase invoices, on the other hand, would also end up in the general ledger. Then any pay slips under human resources, if you do pay slips under payroll, they would end up in the general ledger. If you do manage inventory and you have variances like stock take variances or losses, those would end up in the general ledger to balance your inventory, adjust your inventory, and also record any loss or profit based on that variance. If you do production, so you make products or assemble products, they could also adjust your general ledger. Then, of course, one of the most important aspects of any accounting system is your bank transactions. So every week or month you would be capturing your bank statements directly off your bank, and they would basically serve as a check and balance against transactions in this system. So if you do a sales invoice, you would expect down the line to receive a receipt from a customer. So a customer would be depositing money into your bank account that is related to that specific sales invoice. And only once the cash matches the actual sale can you check that transaction and ensure that first of all the customer doesn't owe you money, and second of all, if the debit and credit columns balance, your financials are in fact correct. So that brings us to bank statements, which is an extremely important part of your financials. If you get this wrong, your financials are basically useless, or you can't trust anything about it. So what you need to do is import a bank statement. As I say, do not, depending on the amount of transactions going through the bank, this could be on a weekly basis or on a monthly basis. Doing it less frequent than a monthly basis would probably be a mistake. But the way you do this is you download an OFX statement or a CSV statement from your bank. In most cases it has to be OFX because that's an international standard, and it would ensure that the system can read those transactions effectively. You would select the bank account that the statement is for, and it then imports all those transactions and expects you to allocate those transactions to different general ledger accounts. So for instance, if a customer pays you money, you would need to allocate that money to the customer account in the system, and also probably the invoice, because if you don't allocate it to the account and the invoice, the system doesn't know which invoices are unpaid. And in this way, you need to assign every single payment and receipt in your bank account to a specific general ledger account, and maybe add some extra detail. Once you've done that, you have to reconcile your transactions, and that just comes down to you need to make sure that the bank balance in this system is the same as the bank balance on your actual bank account. That is the most important concept of accounting. If your bank accounts don't reconcile, your financials are worth nothing. So that is the most important aspect, and you have to be very prudent and consistent, and you have to have a proper system to ensure that this gets done on a regular basis and you never neglect it. At the end of your financial year, the reconciled balance of each bank account has to be perfect to the cent. That's the only way that your financials can be trusted. On top of these journals, you can also capture assets. So often you would be buying something, but it's not an expense, it's an actual asset. And those need to be recorded, created as an asset in this on this tab, and then any money spent or received against those assets have to be captured that way in the bank statement or on invoices. Journals can be used to adjust the financials. So a typical journal transaction would be if you sold a specific asset or written off something, you can create a manual journal entry that records that specific adjustment in your financials. It's also possible to use journal transactions to move money between different business units. So in this system, the Orax system, each Orax system allows for only one company, or let's then say only one group. You cannot create or capture financials for several different groups, but it does allow you to subdivide those financial transactions into what it calls centers. So those are basically divisions or departments in your company. And so you can split your financial performance into different divisions so that you can individually measure the profitability of each center. Well, if you do that, you can then in ledgers adjust movement of money between those centers under the journals tab. That means you can either do a once-off movement. Let's assume you did a big sale, but 50% of that income has to be allocated to a specific department. You can do it there, or you can do an automatic monthly. So let's assume that a certain costs or income should always be split based on percentage or a specific amount. You can add it here and the system will automatically do those splits for you to ensure that all your different departments or centers do get their correct allocations. These two tabs are the customer basically outstanding, the debtors aging report. This tells you which customers owe you money and when it's due, and the suppliers on the other hand shows you your creditors aging, who do you owe, and it helps you to know when to pay and when not to pay. There's actually the suppliers module that helps you with that. You can record supplier invoices and load them according to the terms of that specific supplier and get them approved in the system, and to ensure that you do pay them on the correct day. So on the reports, you also have some basic overview reports, like for instance your asset list, or you can record small assets and your inventory list. The system shows you the general South African inflation rate per month. There are a few ratios that you can use if it's applicable to your business. It shows you your breakdown sales based on gross profit. So this will show you how much you're supposed to sell in order to make a profit or break even on gross profit. On this side, you've got your tax submission reports, your VAT, your pay-as-you-earn report, and then several other employee reconciliation reports, a report for debtors and creditors, opening balances, journal entries. There are some links to the South African Revenue Service. And then down at the bottom, it'll show you any issues in your system. If you do capture invalid transactions, which are possible, or some of your accounts are set up incorrectly, it could cause a balance issue in your general ledger, and they will be shown here, and you need to fix those, otherwise your financials will not be accurate. For instance, if it's a customer aging issue, it means that the statement the customer receives may not be 100% correct because you allocated funds received from a customer incorrectly. So when it comes to setting up your company, one of the most important things is to first of all ensure that your accounts are correct. If you're starting fresh, you can use the basic accounts created by the system. This is all done under the company setup module. In here you can go to general ledger accounts and you can create a standard set of accounts. You can then change it. In most cases you will be migrating from a different system, so you may want to import new accounts using a spreadsheet, or just make adjustments in this list. You can add new accounts, you can click on one account to edit it. Each single account in the system will be either a sales account. You can see the accounts are split up between income statement accounts on top and balance sheet accounts at the bottom. So an account has to be one of those. In your company setup, you can set up services. They will automatically have corresponding general ledger accounts. These you will be selling. Products are inventory items that you sell. They also have their automatic corresponding general ledger accounts. Each individual item has an account in the general ledger. It's automatically done for you. So once you've created your inventory, your sales items, which could be services or products, you are ready to start selling, and the system will take care of the rest. Keep in mind that products, the system keeps inventory levels for products, where services have no inventory levels. It's just a service that you sell. Then when you create assets, the system will keep track of the write-off period, and of course they will end up in your balance sheet and on your trial balance. So each asset has a corresponding automatic general ledger account. The general ledger accounts tab technically include all general ledger accounts that are not catered for under the other tabs in this system. So for instance, a bank account would not be in the general ledger accounts. You would create it under bank accounts, but it would also have a corresponding general ledger account. The same with expenses. So technically all of these tabs are general ledger accounts, but they just managed differently. So you can create a bunch of expenses that you want to record your expenses against, and they would technically be general ledger accounts. So the combination of all these accounts allows you to, makes up your complete general ledger. Remember that every single account has a debit and a credit total, and they will all have to balance at the end of the day. So when it comes to bank accounts, you can create as many bank accounts you have, because you can transfer money between them, so long as each bank account corresponds to a physical actual bank account in the real world. But you can also use cash book accounts. So if you do have cash in the office you want to manage, you can use it for small loan or any kind of small cash management accounts. You can create your own accounts here. Let's assume you do have a payment gateway. You will be creating a bank account for that payment gateway, like PayPal or PayFast or something like that, and manage all the money that moves through that account in here to ensure that you do not slip up on that specific account or miss something. It's all a case of catching any exceptions. So this is all set up in here. Once you are set up, you probably won't make a lot of changes to your general ledger. But in order to start, you always want to start your financials on the beginning of a financial year. In most cases, that would be the 1st of March. Then you need to bring in opening balances. If you've been trading on the system, you will probably use the previous year's closing balances to import them into this year's, the next day's opening balances. If not, you can import those from a spreadsheet, and keep in mind that there are two separate types of opening balances. The one is for your general ledger and the other one is for your inventory. You never bring in opening balances for income statement accounts. So your sales account will always start at 0. Your expenses will always start at 0 in the beginning of the year. But assets and loans and those kind of accounts will always start with an opening balance based on the closing balance of the previous year, which is just the previous day. The inventory is exactly the same. It's an asset, so you would need to bring in the balance for every single item in your inventory, and that is handled separately because you could have many thousands of inventory items. It's handled separately from the normal GL, and you can also do that automatically if you've been trading before. Otherwise you can load them through a spreadsheet or something like that. Once all your opening balances are loaded, you need to make sure that they balance, because an opening balance is nothing other than a debit or a credit amount, and when you add all of those together they should balance at the end. If they do not balance, that discrepancy or that variance will be posted to the retained income account, which could be valid, because if you made a profit in the previous year, that would be posted to the retained income account. But it's important, of course, to start your financial year with the correct opening balances, otherwise your closing balances won't be correct. No matter whether all your transactions during the year were perfect, if you started with the incorrect opening balances, closing balances will also be incorrect. So, to just quickly overview this, you need your general ledger accounts correct, and then as you trade, post your transactions, capture your bank statements, add any assets, and view your financials on a monthly basis to ensure that everything looks right. If your financial reports look right and your bank accounts reconcile and you're happy with that view, your balance sheet is correct, then your financials are probably accurate. But if you neglect anything, you probably won't be able to trust these financials, and then they are basically worthless. Accounting is one of those things you cannot do it halfway. It has to be perfect or drop it, because otherwise, if it's not perfect, it doesn't mean anything. You cannot trust it. Only way to manage it is when you can trust it.